Morning. Welcome to the KittyHawk Investor Series. My name is Will Weisman. It is a great pleasure to have you joining us today. At KittyHawk Ventures, we are focused on seed stage frontier technology investing. And we think this is really one of the most extraordinary times to be investing, and a time where you can not only realize outsized returns, but you can really have an extremely positive and outsized impact on the world. One of the things we also are very focused on is building a community of growth-minded investors, of operators, and on the call today, we've got some of the most important members of that community joining us. So welcome. It's great to have you with us for what I know is going to be an extraordinary conversation. So today joining us, we have Vinod Khosla. Vinod is a titan in the venture industry. He spent 18 years as a general partner at Kleiner Perkins before starting his own firm, Khosla Ventures. He has been making bold, big investments, having absolutely outsized returns and an outsized impact as a group of growth-minded individuals. And as a group-minded individual, it is a great pleasure to have him here with us and for us to get to learn about his experiences. So with that, Vinod, welcome. It's really a great pleasure to have you here, my friend.
Great to be here. I always enjoy talking about startups and the startup ecosystem.
Thank you. So I thought maybe we would start off by, talking about what you've seen in the companies that you've been involved with and what you look for. You really have, been involved with some really extraordinary companies, everything from Juniper Networks to more recently Affirm and QuantumScape and DoorDash, and, on the Midas list frequently. So clearly you have figured something out, how to spot great companies, how to help nurture them and help them realize great outcomes. And so I'd love to kind of understand, what do you look for? And, are there any must-haves and any things that are just huge red flags that you try to avoid?
Well, there's two things that are very large. One is the founder itself. Are they going to have a large vision? Are they going to build a large team? Will they be self-aware how to go be ambitious? The second is, of course, are you operating in an area that can be huge eventually? People focus too much on the short term. I tend to focus on what can be huge in 5 or 10 years. So even when we make a small seed investment, a couple of $1 million, I'm thinking, can this grow up to be $1 billion in returns for us? As odd as that sounds, that's sort of what we shoot for. That's pretty different than people who want to build, and especially to our founders. It's sometimes makes a lot of sense for a founder to start a company, sell it quickly, make $10 million and go home, or go make their wife happy or a husband happy. So it is the ambition of the founder to really change the world. I tend to find those are people with a very large mission, not really a desire to build a company. So I always say there's a huge difference between a $0 million company and a $0 billion company. The revenue may be different, the same, but the attitudes are very, very different. It takes a lot to sort of see what the founder is oriented towards. My biggest disappointment is you make a seed investment. We make a lot of seed investments like yourself, and the founder wants to sell and you get a 5x, which might be nice, but it's completely uninteresting in the seed space for us. Now you get a founder like, let me pick a couple of examples. Pat Brown at Impossible, right? That was a great seed investment. I think it was $3 million, but that was before he had a company. He was a professor at Stanford, but it was clear his vision was large. And so he was clearly shooting for a $0 billion company, not a $0 million company. So that's a great example. When we seeded QuantumScape, we knew it'd be a tough, hard road, but the founder was committed to a very large company, and it's worth about 10 billion now. As a public company, I think it could own a very large part of the EV battery space. So in both these cases, the space is huge. The founders want to go after it, and small outcomes are uninteresting to the founders. Now, to be fair, the other strategy is also a good strategy for funds. I'm not suggesting ours is the only good strategy. It's what we look for. We like, as I like to say, I don't mind a higher probability of failure as long as the consequences of success are really consequential.
What kind of failure rate do you actually have?
It's hard to say. It's been a while since I looked at it. And it also depends on what you call failure.
Yeah.
But I would guess something north of 50% of the investments will give positive returns. But they're largely not what matters. It's the occasional one that'll give a 50 or 100x in every batch that makes all the difference.
And
So,
how are you thinking about ownership as you make these investments? Is that a critical piece of your focus as well?
Well, early on, it clearly is a critical focus when we're doing seeds, because we spend a lot of time helping these entrepreneurs think about how to build teams, how to look at strategy, what technical risks to take, what not to take. We advise them a lot. And that at that point, ownership matters a lot if they want our advice. But later stages, you're investing in a Stripe. Ownership isn't the way to look at it. It's how much money and what multiple could you get.
Gotcha.
But even in a later stage investment, we look for multiples north of 10x. We're not happy with 3x.
Yeah. And how often, I mean, since I've been doing this, and I spent some time at Foundation Capital when I was right out of business school, and and Mavron, it always seemed that it's very tough to tell which companies are going to be your winners. And often there are major inflection points, either the market catches up or there's a change to the business model that all of a sudden allows the company to accelerate. Do you find that to be your case, or do you find that a lot of times the mission and vision that the entrepreneur and the team has crafted really ends up being what they realize?
Well, I think luck plays a huge part, in people who don't acknowledge that, I think, are fooling themselves. So luck does play a huge part. But the flip side of that is one has to give oneself a chance to get lucky. So, this is not just luck. It's placing intelligent bets on good founders, on large market spaces, and then hope you get lucky. So one way I explain it, if there's 10 factors that decide whether a market is huge, whether something will be a huge return or not, a founder may control 3 or 4 of them. The environment or other factors, including competition, may control 3. And then luck just plays the rest of the role. Nobody could anticipate COVID. So a company like OpenTrons, which was a seed investment, just took off. They've gone from probably a $12 million run rate to a $300 or $400 million run rate in the course of a year. And so you do count on getting lucky. Now, there's companies like GitLab. When we invested, we loved the founder. It was clear we liked the space. But I wouldn't have predicted it could be 10, 20, $30 billion company. Today, its last valuation was around 6. I think it has potential. So, and even when GitHub was sold, it was hard to say this kind of an ecosystem would be that generate that kind of value. So I'd say betting on the right space with a lot of developers involved was a good move. Betting on this founder was a very good move. Both were clear in the beginning. How big the space was, very hard to tell. I always use the example of Twitter or Square. When we invested in Square, and I first ran into Twitter, both with Jack Dorsey, it was hard to tell how large the space would be. But the mission was clear. Jack was clear. It was clear he wanted to change how small business was treated. Now, it could be a huge space. It could be a smaller space. The only company that was successful in Square space, and it was only 4 people with a small $10 hardware dongle, was Intuit, which we had invested in when I was at Kleiner. But it was clear that this was going to be more than the hardware dongle. So we paid up and invested in the first round when it was 4 or 5 people. And that worked fairly well.
And are you all identifying areas of interest, like either technologies or sectors that you think are emerging and kind of creating a hypothesis around that and then going out and trying to find companies? Or is it more opportunistic and just being outbound and connecting and reading and leveraging your network that leads to your best investments?
Well, I think we do both. So Food and Impossible was a thesis. We had a thesis around climate change. And by the way, people think climate change wasn't successful. QuantumScape returned the fund. Hopefully, when Impossible is public as a climate investment, that was in 2011, it'll more than return the fund. So the first set of climate investments actually worked out quite well for us with large returns in cement, in aviation fuel, in batteries, in view glass, a couple of different areas. So I could point to 4 or 5 things that are very large returns. And so the investment will make sense. It just took a lot longer. And that was the case. Now, other areas, we just look at inbound and so we don't only do thesis investing. In healthcare, 7 years ago, I wrote up a paper called 20% Doctor Included. That was a thesis around the digital transformation of healthcare when everybody thought that sounded like baloney. In fact, the paper was pretty heavily criticized. About 4 years ago, I wrote a paper called Reinventing Societal Infrastructure with Technology. It was a 50-page thesis I wrote for myself, but I put it on the web. And that said, there are investments around these theses that we will make. And I shared it with everybody because it's always great to get feedback and critique of it. As a result of which, if you ask me what's interesting next, what's like the next impossible, we have a company called Mighty Buildings that's 3D printing whole buildings.
Right.
Now, that sounds ridiculous to most of your audience today, but if they're in California, they can order a unit and then tell me if it still sounds ridiculous after they get a unit. Backyard ADU cottage, developers developing a whole community near Palm Springs just with our technology, 3D print the whole community. As ridiculous as it sounds to people. Could that be a 10, 20, 50 billion, $100 billion company? Absolutely, in market cap, but it's very high risk today. Interestingly, we've led the last 3 or 4 rounds of the company from the first seed, which was $2 million we increased it later to $4 million seed, to the last round where we put in, I think, about 15 million. So
Vinod, can I ask you a question? So one thing I know you desire is to find companies that have an unfair competitive advantage or to help them create
Mhm.
one. For a business like that, or how do you think about creating a sustainable competitive advantage for something there? Is it technology? Is it capital? Is it first to market and a combination of the technology and capital?
So take Mighty Buildings, the company I'm referring to. By the way, we had 3 or 4 investments. All of them I'm excited about, like Juno and others. But Mighty Buildings, it's the printing technology that's very unique. When you want to build, print 1-story, 2-story, the goal is even 5-story structures over the course of a few years, it takes a lot of technology. It takes brand new materials. Instead of printing with cement, which a few people are attempting, which is, in my view, never going to go anywhere, we've developed new materials. And developing new construction materials, in this case, it's photopolymers, is the large risk. So there's going to be a huge technology risk. Let me take another area. We just made a seed investment in public transit. Very unusual bet.
Hmm.
How do you invest in public transit? I actually think we have a very ambitious goal of replacing 50% of all cars in all cities in 20 years. Now, that sounds ridiculous, not as ridiculous as 3D printing buildings, but it sounds ridiculous. I'm convinced the technology is there, the opportunity is there, the economics work, and the founding team has this large vision. Now, there's 100 things that can go wrong, including competitors, politics, regulation, timelines can be large, but we are not afraid to do that. Just like we're not afraid to invest in Commonwealth Fusion, which is a fusion reactor company. We invested a few years ago. If they're lucky, they'll have their first product in 2033. I'm absolutely convinced there's billion-dollar valuation to be created in the short 3 to 5 year time frame, maybe even multi-billion dollars. Let me
So can I
make
ask
a
you,
general.
given the timeline there, Vinod, with Fusion, is that one where you would look to get to exit before they've actually launched a product, or have you actually have terms with your fund that allow you to go into 10 plus 2 or beyond 10 plus 2?
Um, we have 10 plus 2. We think it might fit in that category, but
Hmm.
we are not afraid to stick longer. We have good relations with our LPs.
Gotcha.
Take something like QuantumScape. We invested more than 10 years ago. We still hold the stock, even though it's public, because we think there's large upside. Now, this is all public information. It's a public stock. It went public last year. Uh, we never sold a share, even when it achieved a $1 billion valuation. And we've held on since. We haven't decided when we'd sell, but we were fairly fortunate. So we do balance the long-term bets with shorter-term bets. The same fund had Square in it, which is not this huge 10 years to first product kind of company. So Square, Stripe, Affirm, DoorDash, all our portfolio companies, Instacart, have a very different profile. So we mix the short-term profile with the long-term profile, and then count on a good relationship to decide when to distribute. But I'm not thinking about exit or distribution in Commonwealth Fusion. What I care about is the funds we've had. Our first public fund was 2009. To every fund since, that they have a path to very large returns and very large multiples.
And thank you for that. I appreciate it. And as an emerging manager, I find this super insightful and fascinating. So thank you for sharing your wisdom here.
And to your investors, what I'd say is, if you believe in the manager, then you should take the long view, because of lot of large appreciation comes after a company's public.
Mm.
Even Google. there's been in the last decade, look at the multiples or Amazon or others. I was fortunate we invested in Google and Amazon when I was a decliner. But holding on and being patient when you fundamentally believe in a thesis is a very valuable thing to do. So taking the long view, and especially since you deal with a lot of family offices, uh, they tend to have longer views than say a hedge fund, and so it's a pretty good sort of metric.
Yeah, thank you for that. I'm curious as to your outlook on the world and whether you're optimistic about what you're seeing or concerned about what you're seeing. We're obviously living in an extraordinary time of transition, and it's creating all sorts of new opportunity for creating great businesses, and there's an unbelievable acceleration that's taking place, but it's also creating a lot of changes and destruction of existing incumbents and challenges throughout US society and globally. And I'd be personally curious as to how you think about where we are and the role of kind of capitalism in that.
Well, so we should look at two separate things. The world is changing in a business sense because 15 years ago it was hard to say technology affected society in fundamentally. Technology investing was about technology spaces like mobile and internet and enterprise software and a few medical devices. Today, technologies investing is affecting everything. I just mentioned construction, food, um, public transit, healthcare. And in fact, I forgot to mention, I wrote a paper, this Reinventing Societal Infrastructure with Technology, that fundamentally addresses this thesis of mine that technology will now affect all areas. One couldn't have expected an Uber to change transportation in the way it did, or an Airbnb to change hotels, or pick your favorite, or Amazon to change retailing. Definitely not imagine 96 when we invested. So that's one set of metrics. The other is social factors, which are not investment related. So I do think technology has this huge opportunity to affect society and create business opportunities. But the social upheaval that we are seeing mostly has good factors in my view. So take things like BLM. We may not love, and I don't love the extreme, but I think they're raising questions, often using technology media to address issues like inequality. I think that there's a fundamental issue with capitalism because it's been hijacked for the benefit of the few. And as a social mechanism, it was designed to maximize social benefit. It still is by far the best system. So I would never argue for getting rid of capitalism. But it has to be changed to bias for equality, to change the distribution of rewards from capitalism is just a few rules. So if you change societal rules like can you get MLPs in oil and gas, which is a tax structure, it changes capitalism. MLP is not, or depreciation rates or R&D tax incentives, they aren't fundamental part of the capitalist principle as Adam Smith designed them, or tax rates. They are essentially changes to the system because we decide to optimize different things at different points in time. I do believe we have to optimize not just for GDP growth, but also for equality and distribution of equality. About 5-6 years ago, I wrote a piece in Forbes saying, and this is very important because AI is a huge factor for the next decade or 2 decades and will fundamentally change many aspects of society including employment and other factors. But I wrote this piece called AI Will Increase GDP, Productivity, all the metrics of economics, and will dramatically increase inequality as a result. It was the first time in 2015 I called, for example, for universal basic income. That was 2015, before it was fashionable. It was a longish piece, about 5,000 words in Forbes. I recommend people read it. But various versions of capitalism has to be changed to change the rules on how distribution of the rewards happen.
And are you optimistic that we're going to make those changes?
Well, I'm glad there's so many social pressures, what feels like upheaval socially in every part of the world. Some of the political results we are seeing between the far right and the far left, and I think it's raising the right sets of questions. Now it's up to us, and it's hard to predict when and how these get addressed.
Right, gotcha. And maybe as our last question here, it feels like we're living in a very interesting time in terms of the frothiness of the markets. And I'd be curious with you, you've seen a lot of cycles here. Where do you think we are in this current cycle and in the venture cycle? It looks like we're on track to have another record year in venture investing. And do you see this continuing on?
So let me suggest the two underlying factors. One is there is many more areas to innovate in with technology and venture investing. Like I said, food wasn't an area for venture investment, definitely not on Sand Hill Road when we started doing that. Construction mostly isn't today. Healthcare was more smaller domains. So many more areas to innovate. Fintech has been completely changed. Blockchain is changing things. So there's a lot of interesting areas, from fintech and insurance to blockchain to hard physical areas like transportation or construction or housing. And that says venture capital can handle a lot more money coming into companies. That's one underlying factor. If you add on top the fact that when people see these large returns happening, when you see a Google $1 trillion market cap being built, over the last 10 years, the top of the S&P 500 is now all tech companies. And multi-trillion-dollar companies and companies like Exxon are very marginal now. You see frothiness. And so you have a frothiness overlaid on top of very fundamental and good phenomena. How that changes or plays out, I will say the following in ending. I believe most companies being invested in will lose money, but more money will be made than lost. And so, the smart managers will do very well, but, the euphoria will be there. This happened in 98. There are companies that came out of 98 that did very well. And the bubble that burst in that, 96, the internet bubble started. By 2001, by 9/11, it had burst. Even in 2000, it was bursting. We saw the same phenomena in 2008, triggered by a crisis, but generally because of too much optimism. So I do think we have indiscriminate optimism today, but it's overlaid on top of very fundamental phenomena that are long-term and will sustain for a very long time. So it comes down to who gets left holding the bag. A very good example. Clean tech was not a fashionable area. Then it became fashionable. And then nobody wanted to invest in clean tech. It's coming back now. But the fundamental investments, if you stuck with a QuantumScape or a LanzaTech or cement or Uglass or some of these areas, Tesla is a good example of clean tech, you'd see the returns. So as always, it comes down to the judgment of the managers.
Gotcha. Well, Vinod, I want to thank you so much for joining us today. Really some incredible nuggets in there. Always a pleasure to see you and talk to you. And I hope our paths cross again soon. So thank you, sir.
Great. Thank you. Bye-bye.
Bye-bye.